The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the November edition of Digging into the BI. This is where your folks from the Maryland chapter and the DC regional chapter get together and look at the stocks that are featured in the latest issue of Better Investing, either in the magazine or what we have found from their website. And so here are the four stocks we're going to be looking at tonight. It's going to be Edward Lifesciences, Palo Alto Networks, 3M, and Axios Bank. And we're glad you're here. I see we have some of our people that took the Intro to the SSG class this weekend. Thank you. Glad you're here. And let's go to our next slide. So here's our standard disclaimer in that we're doing these presentations for educational purposes only. There's no recommendation to buy, sell, or hold a particular stock. We believe, as Better Investing does, that investors should conduct their own review and analysis of any company that you're interested in. Any securities that are presented here may be in our own personal portfolio, and we'll try to alert you to that. But please remember that whatever we're showing, whether the stocks or any places that we go to get information, is not an endorsement or promotion of those particular websites, products, or services. And we are recording this, and we will put it up on YouTube, hopefully a lot quicker than we did last month, but we'll do the best we can with that. Next slide. So here's a little bit, again, I see a lot of people that are regulars, but in case someone's seeing this on the internet, who Better Investing is, this is, if you see any of the underlines, the blue underlines, those are hyperlinks. So those people that have access to these slides, you can be able to take a look at it. But this is, we're a long-term fundamental investing organization, and all of us here are volunteers. None of us are in the financial services field or do anything like that. We just enjoy doing it. Next slide, please. And we also have our YouTube channel, as I mentioned. There's where you can find the information on it. This is free. Anyone can get it. Do us a favor when you go there. Make sure to like subscribe to the channel, like the individual videos, not just one, but the ones that you're looking at. And then make sure to share it. You can be able to share it with people in your club and friends. And what we've also done is, if you look over on the right-hand side, each of these webinars are organized what YouTube calls chapters. And if you look at the bottom of the webinars, you're going through it, you'll see little breaks in there, and that will take you up to the next thing. So we divide by the stocks and stuff that we do at the beginning and also at the end. And let's help us sort of slowly grow this community, and we're glad you're here. Next slide. And so, like I was saying, you can get the handouts. And if you open this up, you'll be able to see over on the right-hand side, you'll see a drop-down arrow where I'm pointing it with the green arrow there, and it will go to handouts. And you have 4 completed SSGs in a PDF. And you also have this slide deck that you can be able to take a look at. And like I said, the slide deck, if you open it up, and you're connected to the internet and you click on any of these blue underlines, like the one up here on top, you'll be able to go to that location on the internet so you can be able to talk about it. We haven't had any audio problems in a while, so we'll sort of pass that for the moment, but there's ways to be able to take a look at it. Let's go to our next slide, please. So why are we doing this webinar? Well, we're doing it to be able to help beginners, people that are uncertain of their judgment, or people who just like to be able to look and study at stocks, how to be able to use the stock selection guide. Sometimes we'll talk about the PERT report, but we're really trying to show you the best practices that we use in the Better Investing, a long-term fundamental investing community. We're also doing this, like I said at the very beginning, it's a joint program between the 2 Mid-Atlantic chapters, the Maryland and the DC regional. We are trying to promote our model clubs to be able to let you know. And there's also, we call it the Visit a Club program, but when Cheryl gets to it, it's a new program called Club Connect. And it's a way to sort of connect with other people in Mid-Atlantic. But if you're not from this area and you're listening to this from outside Maryland, DC, or Virginia, we're welcome that you're here. Please share this with your other friends. It's not a restriction. Please share. Next slide. So what we're going to do in just over an hour is we're going to present 4 stocks. 2 will come from the BI magazine as a member-only publication, and it will be the stock to study and undervalued feature. And then we're going to do two other presentations that will come from either the website or magazine. It could also be from personal experience. And down below, you can see some of the locations in the Better Investing website that people use, like either the First Cut, online screening tools, the heat map, ticker talk, weekly screens, and on and on and on. So you can be able to see there's a lot of places to get good stock ideas. And we're just really trying to show you how to be able to take full advantage of your Better Investing membership. Next slide. So here's where you can be able to see what the upcoming stocks are. And as you can see, I have highlighted in red the two that we're going to be doing tonight, Edward Lifesciences and 3M. They were announced all the way back on August 29th. And as you can see, there's two announcements above where we are right now. So they already have the December and January 2024 in there. And you do not have to be a BI member to see this information. It's just up on the free part of the Better Investing website. Next slide. So if you are a member and you want to be able to get announcements, the way to do it is if you look up at the top where I have the red circle and says My Account, once you sign, you have to be signed in, of course, you click on that and you'll go over towards the left-hand side in sort of the center left, and you'll see the thing that I have circled in green, which is the email and product subscription information. If you click on that, what happens is the green box over on the far right opens up, and you'll be able to click on that for local chapter news. So if you click on that and you're in the Maryland chapter, you will get the Maryland chapter news. If you're in the DC regional, you will get that. If you're in another part of the country and their chapter, they will give it to you. But before you hit that Save Changes that I've circled down there, where Cheryl's pointing in the yellow highlight is a BI Weekly newsletter, and this is what it's going on there. This is a member-only production, and what it does, it highlights the national education that's going on, and again, it will tell you of upcoming webinars that they do, Ticker Talk, Stock Up, some of the First Cut reports that are coming in there. It usually comes out the close of business of Thursday, and if you signed up and you're not getting it, check your spam filter. What I'm highlighting with that sort of goldish arrow up at the top is the new Club Connect program, and Cheryl's going to talk about that in a couple slides. So if you're in a club and you're looking to be able to let other folks find you because you're looking for members, you can do that. And if you're not in a club and you're looking for a club, you can click on that, fill out the information, and you'll be able to find clubs that are near you. And then down below is a ticker talk that's coming on up. I can't see it. I think that's just next week. My eyes can't see it. But anyway, take a look at this and you can be able to see it. Next slide, please. And we're also up on Facebook. Both the Maryland chapter and the DC regional chapter have Facebook pages. I've always suggested that perhaps we combine because we don't put that much traffic out on there. But this is something, again, that can be shared with both BI members and non-BI members to be able to see what's going on. And again, if you're trying to be able to show people what's going on, prospective people into your club, you can show it these as locations to be able to get more information. Next slide. This is something that's being done by the Maryland chapter. They have a meetup, and it's a great way to be able to connect with other people. You don't have to be in the Maryland chapter. You don't even have to be a BI member, but they do run different programs through there. There's 9 chapters across the country that end up having this meetup, and it's a great way to be able to connect with some of the other folks that are in your community. If you don't know about Meetup, down in the blue box down there, I have hyperlinks to be able to tell you a little bit more about Meetup and seeing how it works. Next slide. And Roger, I don't know if you want to get on and tell us a little bit about what's upcoming with your chapter events. I know you guys just finished your SSG class just like we did. And you're also, I think you're busy working on your stock pickers contest. Is that right?
Yes, we're going to announce a stock pickers contest probably around the middle of December for next year. It'll start probably the last weekend in January and run till I believe the last weekend in August. It's 30 weeks long, and this will be the 3rd or 4th year that we've done it. Anybody who's a member of the Maryland chapter or any investment club that's a member of the Maryland chapter can participate in it. We have a prize structure that depends on how many entries we have. So
Very good. It's
it'll
fun.
be listed under local events. The
Mhm.
information will be listed under local events on how to sign up for it. Probably again around the middle of December.
Thank you very much. Yeah, I know my club participated in it, and I did too. Next slide. Cheryl, tell us about what's coming up with the DC chapter.
Except for the month of December, we have a Money Matters book discussion. Usually one of our members presents a book, and this month it's going to be Kevin Galogly, and he is going to do Where the Money Is, Value Investing in the Digital Age by Adam Sesfel, and probably butchered his name here, apologies. And that is going to be the third Tuesday of the month, which will be the 21st of November for this month, between 7:30 and 9 p.m. And that is online. You can go to our local events where the blue arrow is, and you can go find the link, and then at the appropriate time, click on the link, and you'll be there.
Thank you very much. Let's
Okay.
go to the next one. Ken, tell us about your club.
So Happy Destiny Investment Club was started in 2001. We currently have 9 partners. We meet on the 3rd Friday of each month from 6:30 till approximately 9 o'clock. And we meet online. Our next stock study will be Arista Networks. And if you'd like to reach us, you can contact us at diggingintothebi@gmail.com.
Thank you very much. And we'll go to the next one. Roger, tell us about your club.
My club is the SCS Investment Club of College Park. It was started in 1972, and we currently have seven partners. It meets on the second Tuesday of the month, so our meeting this month will be on the 14th. And generally, our meetings are short. They run from 7 to 8, and they're online. And if anybody is interested in finding out more about it, I am the point of contact for that.
And how long have you been a member of the club, Roger?
Well, I was going to tell that later on, but I'm 50
All right,
years.
okay. 50 years. That's amazing. It's just absolutely amazing. Sorry to steal your thunder. Anyway, next slide, please. And this is my club. This is the Montgomery County Model Investment Club. We started in 2017. We have 5 partners, and if you see that photo, there's more than 5 people in there because we did a joint social event with Pinnacle Investment Group Investments. And so one of our partners is in both of them, and we sort of meet there. And we're going to be doing our education, which is a business segment analysis, and then our stock to study will be Tractor Supply. It is online. There's the link to it. Please reach out. If you're in the Maryland area, particularly close to Montgomery County, if not in Montgomery County, we'd love to be able to talk to you and see if you want to come and join us. Next slide. Cheryl, are you muted?
Oh, good.
Oh, Bhaskar speaking.
Oh, yeah.
My bad. Sorry.
Yeah, this is Model Investment Club of Northern Virginia. I am a partner in this club. This was started in 2008 and we currently have about 13 partners. We meet on the second Tuesday of every month, and this month it falls on the November 14th. We are usually online, like any other clubs. It's between 7 to 9 p.m. Anyone is welcome. The registration link is given. This month, the stock to study, we are going to talk about ACMR Inc. I think it's one of the semiconductor industry. This is about DC. This is about Model Investment Club in Northern Virginia, McNova.
Thank you. Let's go to our next slide. Cheryl.
Okay, now I will unmute. Anyway, this is a new program that Better Investing has set up. Previously had Visit a Club, and they didn't get a lot of hits on either side, either clubs posting or individuals seeking clubs. It got to be kind of cumbersome. So this one seems to be much easier to register your club, as well as for individuals to go looking for a club. And so that is what is currently going on right now. And that is for BI members, BI clubs, and people that are using the free 90-day membership. They're officially started in September, and they're going to be more proactive in connecting clubs with potential partners and with members looking for clubs. So still the decision to join a club or not, as well as accepting a new partner or not, remains with the club and between the club and the potential new partner. So back to you, Kevin.
Okay. And since this is digging into the BI, we want to be able to take a look inside the magazine quickly. And so again, most of you probably already have your paper copy. I have mine right here in front of me, but you can also get it in the e-magazine or on the app. I've asked a few times if people use the app, and most people are no. Some people will look at the e-magazine. Almost everyone here likes to be able to use the use a magazine. In this one, the November issue came out in about mid-October, if not a little bit earlier. But again, the advantage of using the app or the e-magazine is you can use your computer, laptop, tablet, smartphone, or any other electronic device to take a look at it. Next slide. And so one of the things on there when you go there, if you want to get the app, is that it's a different sign-in than what you have for your regular stuff. So where the green arrow is over on the left-hand side, that's where they'll give you the steps to be able to do it. The red arrow is where there's additional information from the two featured stocks, a stock to study and undervalued feature. There's some value line reports and sometimes some additional information, and that's where you can be able to find that. And if you want to get to the actual e-magazine, if you look in the center screen capture where the green View Magazine issue is highlighted, click on that and you'll be able to go to seeing what's there. Next slide. And so here's something that I thought was kind of interesting in this edition of the BI magazine. It was a fundamental of investing column, and it's designed for beginners. And it's just like, it talks about why investors should monitor stock buybacks. And I thought this was answered it kind of succinctly where I have it emphasized over in the lower left-hand side, is that if publicly traded companies issue stock to raise capital, the inverse is true of repurchasing of said stock to pull equity back into the company. And so that's sort of a good way to sort of take a look at things to see how they are. And let's go to our next slide. And there's most of the events here, again, page 51 is where you can find all the events. Most of them were already in October. So even though this is the November issue, they were put in there. But again, the South Florida chapter does I think it's a Learn to Earn program. It's free and it's online for about a little over 2 hours on Saturday mornings. So take a look at that. If it's something that interests you, you can go there and take a look. Let's go to our next slide. Well, we've done enough talking, and now it's time to celebrate our 3rd anniversary. 3 years ago, we started this, and all the people that did the initial presentation are here in the back room with us. And the first one up here will be Ken Williams, and he's going to talk about Edward Lifesciences. So take it away, Ken.
Okay, good evening, everyone. Let's proceed to the next slide. All right, so Edward Lifesciences is the better investing stock to study for the month of November. And there's a nice 5-page article in the November issue discussing the company. Next slide. So as an overview, the company was started in 1958 by Miles Edwards, a retired engineer who set out to build the first artificial heart along with surgeon Albert Starr. It was acquired in 1966 by American Hospital Supply, renamed American Edwards Laboratories, and then it was acquired in 1985 by Baxter International, later spun off from Baxter in May of 2000. They're headquartered in Irvine, California. They're a leader in cardiovascular devices. They are a component of the S&P 500. They've had 3 stock splits over the past 20 years. They seem to split their stock about every 5 years. And if you invested $10,000 10 years ago, it would be worth $63,623.71. Next slide. Cardio health is the highest cost of most healthcare expenses. Edwards reinvests approximately 17 to 18% of its revenues in research and development expenditures. The company's legacy segment, its largest is transcatheter aortic valve replacement, which in fiscal year 2022 produced 65.4% of its total revenues. Its core products include Sapien transcatheter, artificial aortic valves, Sapien products that are used to treat aortic stenosis, narrowing that prevents the valve from opening fully, and certain congenital heart conditions. The surgical structural heart segment accounted for 16.6% of total 2022 revenues. The unit's offerings comprise of tissue-based replacement aortic and mitral valves. The core product is the Paramount pericardial valve platform. Paramount valves are reportedly the world's most widely used implanted surgical tissue heart valves. Critical care generated 15.9% of 2022 revenues. The segment produces blood flow monitors to track oxygen levels, heart function, and fluid status of patients in surgical and intensive care settings. And then finally, the transcatheter mitral and tricuspid therapies accounted for 2.2% of the 2022 revenues. Although it's the company's smallest segment, TMTT is growing rapidly and expected to be a significant growth driver. In 2022, net sales were up 35.1% over the previous year. The global market for such therapies is projected to reach $3 billion by 2025. Next slide. So Kevin Gologly had open heart surgery in August of 2018. He received an annuloplasty ring from Edwards Lifesciences to fix his mitral valve prolapse with severe regurgitation. Next slide. Edwards has a long history of partnering with cardiac surgeons to drive leading surgical therapies. Approximately 50% of revenues are from products that have been launched within the last 5 years. Next slide. The heart valves devices market is expected to experience a compound annual growth rate of about 13% annually over the next through 2032. The compound annual growth rate is expected to be 14.4% in China alone. Next slide. Edwards shows up as a 4-star buy at Morningstar with a fair value of $86 and has exemplary capital allocation. Edwards has a 98 quality rating at Manifest Investing with a par of 15%. Next slide. Edwards has a safety of 2, financial strength of A+, earnings predictability of 100, and its PE ratio of 30.6 is expected to expand to 35 over the next 3 to 5 years. It has a 30 times cash flow multiple, an 18-month growth target of 20%, and a 3 to 5 year annual total return range of 10 to 18%. And its capital structure reflects that its long-term debt is 9% of capital. The graph shows that it falls just below the cash flow line, which suggests that it's slightly undervalued. Next slide. I did a stock comparison with the company's leading competitors, Boston Scientific, Abbott Laboratories, and Medtronic. Most of the growth metric comparisons with the medical devices industry appear to favor Edwards and Abbott Labs. However, when you look at the management metric comparisons with the medical devices industry, Edwards appears to surpass with the three major competitors. Next slide. For those of you who attended the Better Investing Deep Dive series on discounted cash flow, you may be familiar with the business segment analysis worksheet that was presented as part of the education. I applied the approach I learned for evaluating business segments and applied it to Edwards. Based on my normalized judgments for growth in each segment, my overall judgment resulted in an overall growth for the company of 7.2%. Next slide. I'm using the 7.2% as my growth judgment, which is based on that business segment analysis. Next slide. The dashboard was also part of the education in the Deep Dive Discounted Cash Flow series. I'm using the 5-year pre-tax profit margin of 28.3% and the 5-year tax rate of 12.7% as my inputs for preferred procedure. Next slide. Based on my inputs, my resulting earnings judgment is 5.9%. Please keep in mind that preferred procedure is not available in the SSG Corp product. Next slide.
5 minutes. 5 minutes.
Pre-tax profit on sales and return on equity are both above the 5-year average figures. Percent debt to capital has been trending down and it's below the 5-year average. And overall, the debt is down 5% over the previous year. Next slide. I selected the 5-year average PE of 40.8 as the high PE and 26 as the low PE based on the trailing 12-month low PE of 25.9. Overall, this results in a low price of $60.80. Next slide. This results in a upside downside ratio of a 5.5 to 1, and the closing price as of this past Friday puts it in the buy range. Next slide. The resulting compound annual return is 13.7%, which is just above the weighted average cost of capital of 13.6%, suggesting that the return is worthwhile for further study based on what I learned in the Deep Dive Discounted Cash Flow class. The compound return is also within the 3 to 5 year projected annual return range of 10 to 18%, as shown on the value line. Next slide. So Edwards continues to buy back stock. It is investing in mitigating staffing disruptions It is focusing on increasing treatment rates, and they expect to reach 10 billion in annual sales by 2028. Next slide. So in conclusion, Edwards is a medium-sized company. It is well managed with a patient focus for innovation. It is undervalued as it's trading under its 5-year average PE. It is a buy at the current price with a 5.5 to 1 upside downside ratio and trailing returns of 13.7% actually. And I believe it's a worthy candidate for your consideration. Next slide.
Thank you very much, Ken. And now we're going to be able to hear about Palo Alto Networks, and Ed Rodriguez will get us started. Go ahead, Ed.
Good evening, everyone. I'm going to be presenting Palo Alto, which is a pretty significant company. As you can see, it's a component of both the NASDAQ 100 and S&P 500. I found this as part of being on the Better Investing Top 200 list, number 171 specifically. Next. So Palo Alto is a security company. And when we say that, it is a pretty broad and complex field. Palo Alto is actually considered the leading cyber player in this area. It has over 12,000 employees, including 1,000 in Israel. They serve like over 85,000 customers in 150 countries. In those countries, they across the world, they're serving most of the largest companies in the world. Next. So when we say that Palo Alto does security, this is a really complex and diverse landscape, as you can see on this figure here. It deals with hardware, software, information you put in the cloud. It includes software to help you prove you are who you are when you log on to networks and resources. And it helps also companies to understand the millions of security relevant events that go on in an enterprise. That's certainly not an easy thing to do. Last but not least, let's not forget there's always consulting services in a lot of these fields. Cybersecurity is no different. Next. I'm not going to go through each of these, but I did want to give you a quick snapshot of some of the fairly diverse major offerings that Palo Alto offers. We're going to get into some aspects of a few of these in a few seconds. Next slide. So with so many people out in cybersecurity and cybersecurity being so broad, what makes Palo Alto different other than it being the leading player? In my opinion, one of the things that it has done in terms of putting together its service offerings is to emphasize something called the Zero Trust Framework. We're not going to make this a computer security tutorial tonight, but it is a really important way that the federal government and a lot of the leading corporations that depend on information and protecting their information, they're looking at this approach to protecting their systems and their data. For those that might have a little bit of background in security, this is like defense in depth on steroids. Three other things I want to highlight is that Palo Alto is considered a best-of-breed player in some of these specific areas. It has had very strong momentum with its large dollar sale transactions. And lastly, I think it's executing very successfully a build and buy strategy. And this has allowed it to become that largest cyber player. Its market capitalization has increased 3.5 times over the last few years. Next slide. So going through each of these a little bit, I want to point out some graphics here from different reports from Forrester and from Gartner. In the one on the left, you can see that they are considered the premier player in this area that I consider to be a game changer and a differentiator, which is the zero trust platforms. On the right-hand side, you see another area in which they're dominant, something called SD-WANs for you geeks or people that are just curious. SD meaning software-defined wide area networks. So there's your trivia for the day. Next slide, please. When we talk about large momentum deals, I wanted to kind of point out on the left-hand side that when they're making deals with these corporations, these large corporations are buying the entire suite or a good portion of the suite of product offerings that Palo Alto has. It's not just one little niche product here, another little niche product there. They're buying the entire suite. And what that has resulted in, as you can see on the right side, is a fairly significant year-over-year growth in large deals, both above 10 million and above 20 million. Lastly, beyond these great product offerings and the sales team being very strong, these are what I would consider to be sticky, not stick, sticky sales. And by that, I mean, when you get into those corporations, those enterprises, it's going to be hard for them to change out. By the way, this is one of the elements of a successful moat. Next slide, please. Next slide. Thank you. So on this slide here, this is the build and buy strategy. This is how they've been building themselves. As you can see, starting in 2019, they had a limited 13 products that they were offering their potential customers. That has grown at the end of FY23 to 74. They've done this two ways, right? They have done it by building up their products internally, and as you can see on the bottom part of this, through acquisitions. And acquisitions haven't stopped. In this first quarter in 2024, they're going to be spending something about $600 million in the acquisition of those two companies there. So their successful strategy, they continue with it, and we'll see where that leads us. Next slide, please. So what do the analysts think? So as far as Morningstar, the thing I want to emphasize is it is considered to have a wide moat. This is due to its differentiated product offerings that I've already discussed. Over in Value Line, they made an explicit point about talking about raising their estimate earnings for Palo Alto's. So I want to note that this is one of the real important things that analysts look at as earnings get revised upwards. That tends to be a very powerful force in terms of price action and the prospects for that company. Next, we have a recognition that their growth, and I think it's a 29% over the last X number of years, is going to be probably coming back to a little bit normal. So there's a recognition of it, and there's still a belief that there's good growth remaining in this company going forward. And lastly, if you take a look at valuation, and when they say this, it's generally looking just at the PE. It is outrageous. It's something that's acquainted with very early stage companies when the earnings are limited. It is priced to not leave much for error. So that is certainly one of the risks if you're interested in this type of company. Next. So let me take a quick minute to highlight the size of this market. I mean, it's one thing to be a dominant. Nope, go back, please. It's one thing to be a dominant player in a field, but how big is that field? Well, cybersecurity at a global level is huge. It's projected to be growing at 12.3 over the next 7 years. In the U.S., it should be noted that this is a slightly more mature market. So you're not going to see tremendous growth here, but certainly it is the largest company. It's the largest existing market right now, and with the rest of the world being out there. And as a reminder, Palo Alto's well positioned for that kind of worldwide growth with its broad footprint across the entire world. Next slide.
5 minutes, Ed. 5 minutes.
Thank you. All right, so now we'll get into the SSG analysis. I'm going to go through this a little bit quick, but so on this slide, I want to point out two things. One is the list of companies I've listed there I won't go through them all, but what's important is that the default list that BI provided were really kind of completely wrong. So just as a reminder to everyone as they do these kinds of analysis and they want to do, they want to make sure that the appropriate companies are kind of being used for comparison. Secondly, as I mentioned before, their growth has been really strong there. As you can see, they're 29.2%, year over year, 26%. Next slide. Here, this is pointing out one of the one of the weaknesses of BI methodology in general and the SSG. If you don't have a record of consistent earnings, these graphs look ugly. So I'll nonetheless draw your attention to number one here, where in the last 3 years you've seen a fairly significant shift in the performance in this company, leading to a profit here at the end of FY23. And just for kicks and giggles, the number two, year over year has been 6,300% increase, but that's a silly number. Let's move on. Again, because of the methodology, the graphs don't turn out very nice. It's an ugly graph. I do want to draw your attention to two things. From 2019 through 2023, you see a lot of price variance in the stock. So this points out the volatility of this stock with potential rewards, but also potential, nervousness that accompanies that. Number two does reiterate the point of its, in the last few years, its very strong performance. Next slide. Here, in general, if you'll notice the pre-tax profit on sales, not fantastic. It is trending upward now, as number two points out, but it's never been, the company historically has been relatively well run, even though it wasn't tremendously profitable in some of the earlier years. But again, recent years, things are looking quite up. Next slide. Again, I want to, this may sound like a little bit of a broken record here, but notice how the return on equity has really kind of ramped up here in particularly this past year. A reflection of the company finally pivoting and becoming profitable, and those numbers being very good. Next.
2 minutes, Ed. 2 minutes.
Thank you. So here we see the cost of acquisitions. I've mentioned this twice, that part of its growth strategy has been through acquisitions. With acquisitions, that will often come debt. That's what we see here. We also notice a decrease in the last year. So that's a good thing. However, full disclosure, in the first quarter of 24, they have gone forward, as I mentioned before, with the acquisition of two new companies for about $600 million. So you'll see that number go back up, but that's a continuation of what's been a very successful strategy for them. Next. So here are some of the actual numbers. In green, you'll see the consensus numbers. I've selected numbers a little bit below that just to represent the amount of risk and volatility that this stock has. I also took a look at BI sentiment data. That's available on the website, just to make sure, see if there were any outliers, anything that might change my opinion about not having to take a closer look at the consensus number. And there was nothing that kind of troubled me there. Next slide. When we look at forecasting high price and low prices, I always like to take a look at the technical lens, namely price action over an extended amount of time. Here you'll see that there is two price points where I think there's some price support, up at 200 and down at 135. Let's keep those numbers in mind for a few. Let's put a pin on that for a minute. And then the PE, which I like to often use. This is pretty useless given the very recent and very scant earnings information. So those numbers provide no value. Next.
1 minute.
Thank you. Let's see. So what I ended up doing here is going with the 5-year PE average. It is actually lower than the current PE average. Again, I don't think that's sustainable. On the bottom, I elected to go conservative to select the 2-year low price point for the low point on these for the calculations. Next. This basically results in the following chart. We are just barely into the hold region for Palo Alto. Next slide. So conclusion, it's a medium size, very fast growing company, recently profitable. It's well managed, and I think has a great strategic vision. It's according to the results of our SSG, it's a hold at its current price. Not too far from a buy price, and it's a medium risk that a company that's growing fast. And you heard me repeat numerous times various metrics that were rapidly improving over the last 3 months. And I would recommend you keep a really close eye on this. They're reporting first quarter 24 results on November 15th. I think we might be in for a surprise. That's it. Thank you.
Thank you very much. Okay, and now we're going to do 2 and plus, and the first one up is going to be Bhaskar, and he's going to show us the undervalued feature 3M company. So take it away, Bhaskar.
Thank you, Kevin. Good evening, all. This is this was featured as an undervalued stock in this month edition of Better Investing magazine. This is 3M, ticker symbol MMM. Next slide. So this is a large company. This is a large size company. It was, like I said, it is featured in the undervalued stock. This article mainly talks about why it is undervalued. There are a lot of litigation that has been going on for past 1 year. And now it is slowly coming out of all those, which is putting it in a good spot. So far, it looks like it has been beaten up by the market. In fact, in one of the analysts is saying that the Wall Street hates 3M. You can see it in this article. So basically, it's a well-known large company. It has been in the market for a very long time, since 1902. We have visited this stock multiple times in the past. Next slide, please. So this gives some background about the company. It is founded in 1902 in northern Minnesota. They are as a diversified manufacturer on the technology company with operations in more than 70 countries. The CEO is Michael Roman. He has been here since 1988, and he became the CEO in July of 2018. Started as a small company. Today, it's a diversified industrial conglomerate with worldwide operations. They have about 118,000 global patents. 9,000 are held in US alone. They spend a lot of R&D. 5.4% of the net sales is spent on R&D in 2022. Next slide. So it is a leading manufacturer. They cover different areas of the industry. So they cover the safety and industrial, transportation and electronics 26%, healthcare, consumer side, and R&D. Some of the known products are like Post-its, Scotch tape, Scotch Guard, Scotch Brite, which are like we are all familiar with. So this is very popular in some of these healthcare side also. Majority of their income is across the globe. America side alone, it is coming about 53.8%. Asia Pacific is 28.9%, and in other sectors it is like 17.3%. Next slide, please. So this is coming from their recent quarterly presentation. It tells how 11.6 billion in the most recent 2022 sales. It falls on the safety and industrial side, transportation side, and the electronics. It's 8.9 billion. healthcare 8.4 billion, and the consumer side is 5.3 billion. Next slide. So they have about more than 60,000, actually 60,000 products are there. This is some of the categories where they make, like I said, the popular brands which we are, which we know are on the Post-it, Scotch tape, and all those. Some of these healthcare products alone is making several millions, which is contributing to the growth. Next slide. So recently, this like I said, there are few items, few things, few litigation, a couple of litigation. One of them is about the quality of the military grade earplugs supplied to the U.S. service members, where they were saying the combat arms brand earplugs were alleged to be ineffective and to have damaged the hearing of personnel working in loud environments. So these earplugs were produced by Aero Technologies. It is one of the company that was acquired by 3M in 2008. In August, when this in August of this year, I think that's when this article was written. There was this litigation was settled with 6 billion, 5 billion to be settled in cash in over a span of up to 2029, and the other 1 billion in the stock expenses. They settled it, and on the same day there was another litigation related to water contamination of PFAS. It's a chemical called polyfluoroalkyl substances. There was a litigation that it was mixed in the water, in the drinking water. So the public water systems and had this, and they had to pay about 10 billion as a settlement for that. So that was also happened in the same month. So 23 state attorneys dropped their opposition after the announcement. So their company agreed to pay at least 12.5, but finally I think it settled for 10 billion, which is the analyst estimate was 12 billion. So also 3M announced to phase out the PFAS by 2025. There are also plans to spin off the healthcare unit alone. They might go into effect in 2023, end of 2023 or early 2024, which is another another restructuring or change that is going to happen in this company. They are also doing some restructuring where they are going to remove like 2,500 management and above employees, and they are going to use them for different purposes. That effect also will go next year. So there are a lot of things to expect next year. So end of this year, you will still see the negative earnings and negative growth. Hopefully for next year, it is going to pick up. Maybe that's the reason this is qualified under this undervalued stock. Next slide. So this is again in their this quarter priorities. They have three big priorities to driving the performance through 3M, how they are going to expand through operational execution, and the spinning of healthcare, which is coming to a conclusion. So the beginning of 2024, we might see some action progress over there. And the third one is about this litigations, where they want to reduce the risk and uncertainty. These are the three priorities that the company is focusing on for this Q3. Next slide.
5 minutes, Bhaskar, 5 minutes.
Thank you. Thank you. So using the SSG, I am doing this, and if you open, this is not like a good-looking front page because I think this is a very big company which has been there for many years, and it is on the very large size. And you see the most recent quarters are not doing well. It is all showing in negatives. It's mainly because of they were not able to show some income and the earnings, and there were so many expenses that they were incurring due to these various litigations going on. The sales estimate and earnings per share estimate for in the long term is around 2 for a large size company. One is negative, they're showing negative. I am changing my judgments to based on the numbers I'm seeing in the value line. Next slide. So under the company data and evaluate management, the pre-tax profit, the ROE is 43, even though it is like in the downward trend. 43 is a good number for the management. The debt is obviously high compared to other companies. It is coming down, but it's a large company and there are so many things happening with this. The trend is coming down. So on the estimate side, on the sales estimate, sales forecast, I picked 2. The 5-year estimate comes to 37 billion. And if looking at the value line, they are projecting the sales of 38, which is for the percentage-wise 2.5. So I'm aligning that with the value line data. The same thing with this earnings per share. It's 2.1, which comes to 11.15. Next slide. So here there are, as you can see, there are no meaningful figure for the P's, and mainly because of the negative figures. This is not a normal SSG for beginners or normal users. You have to do your own investigation analysis before making some judgments. Next slide. So under the high PE, I picked 18, and for the low PE, I went with the price, which is 65. The 65 is something that was not seen in the past 5 or 10 years. The lowest in the 52-week low was $83. I'm giving some buffer, and it is even lower than that to 65. Based on these judgments, the stock is a buy with the upside downside ratio of 3.7 to 1. Value line is the 2026 to 2028 projections. The low price, it's saying like $140 with a high of 210, or at least in the next 18-month target, it could go up to 137. This article was written in August and the price was $107. Today's price is $93.51. Morningstar gives a fair value of $123. It lowered it from 131. The current price is 93. Still, it looks like a decent buy. Next slide. So the 5-year return comes out to projected average return is 14.9, and the average payout I had to lower it and brought it to 54 compared to its averages. With that, the average return comes to 14.9. With the total high PE, the total return is 19.4. The upside downside is 3.7 to 1. Compare it to manifest investing. Manifest investing increased its par to 17% today. Next slide. So in conclusion, it's a large, quality company which well established, but slow growth company. As you can see, the front side of the SSGs. It's an undervalued company, trading close to its 52-week low price. This has been going through tough times in 2022-23 with 2 litigation which has ended. It's a strong dividend-paying company. It has been paying for the past 65 consecutive years, and its payout ratio is really good. My SSG comes out as a buy with the upside downside of 3.7 to 1, but I would strongly consider you to review, research more before and do your own SSGs. Thank you.
Thank you, Bhaskar. Glad to have you with us. Nice presentation. And next will be Roger Cronchi. And Rogers, you're our 28th different presenter over the last 3 years. So congratulations, and let's hear all about Axios.
Okay, 28. That's about what my age is, I believe. My name is Roger Cronchi. I've been a volunteer to the Maryland chapter for 25 years. And as I said earlier, I've been a member of the CS Investment Club for 50 years. Today's stock is going to be Axos Financial. Next. I originally found this stock using another search engine, and Kevin told me I needed to make sure I could find it using something on the VI website. So I went back in here and picked out some criteria for it. And the items that I picked out were on the right-hand side and ran it. And yes, it came up with 79 other stocks as well. There were 80 stocks in the financial services industry that met the criteria that I had. Next. Here's a little information on the company itself. It's really a bank holding company that provides not only banking, but investment services to the industry and customer securities trading. It's in the regional bank industry, and it's headquartered in Las Vegas. Good place for a bank, right? Next. The company's history. It was founded on July 4th. They picked that day specifically in 2000 as the Bank of the Internet. And the only thing they offered at that time was online checking accounts. Over time, they expanded their product line and began trading as BOFI, Bank of the Internet, and NASDAQ in 2005. And in 2018, they changed their name and became Axos Financial on the New York Stock Exchange. It included all the parts of the bank, as well as a lot of things, well, several things on the securities side. Next. Here's the kind of acquisitions that they've made. Some of these have led to the formation of some subsidiaries or divisions within the company, as you'll see. One of them there is for Axos Clearing, and one of them's for Axos Investment. Whoops, you went ahead. Back up. They've basically taken over several banks, and they've bought apparently assets and things from other ones. One of the interesting thing was, I thought the $140 million in equipment leases that they got from the Pacific Western Equipment. But they've gotten more into the security side with the later acquisitions. Next. The way they're organized is they've got the bank as one side, and they've got the security side as the other. The bank includes everything that they do for consumers and for businesses, as far as accounts and loans and everything like that. On the security side, they have Axos Clearing, which really works with companies that are in the industry that help them do their job, and then Axos Invest, which is where the customers actually can do trading and asset things like that. Next. All right, the first thing I did was look at the pre-tax profit on sales, and found that they have a very good percentage of profit. In the last 5 years, the lowest value was like 43.6%. Their average for the past 5 years has been 46.9, and there's 4 companies there that are listed as a peer group. I'm sorry, 3 as a peer group. And the peer group average in the industry, and their Axos pre-tax profit on sales has got the highest 5-year average of any of the companies. Next. All right, return on equity. Again, this looks kind of like the last one. Their last 5 years, their lowest value in the last 5 years for this was the beginning of 2019, 14.7, and it's up to 16.2 now. Their numbers are still the highest of the peer group and the industry. Next. Comparison of debt to capital. They had the second lowest percentage, and that's what we'd like to see as a low. As you can see, their debt to capital has been dropping for quite a number of years. The only one that had a lower percentage than Axos was Affinity Bank Shares. And one of the things about Infinity, I noticed they got 3 years with numbers here, but they only have 2 years where they've actually been publicly traded. All right, next. Take a look at the high PEs. The high PE for the company is not very high. It started off probably at 27 back in 2014, and it's down to 10 in 2023. It pretty much has dropped all along the way. They're the third lowest one of everybody on the list here. And part of the reason may be based on the acquisitions. I don't know. That kind of surprised me. Next. Comparison of the low PE. Oh, got to turn my page here. Again, they got the lowest average here on the page. Their number has been reduced by about 3 numbers, from 9.6 to 6.5 in the last 5 years, and their average is 6.9. Next. Bank revenue adjustment. Better Investing makes a special calculation to deal with banks. Trying to minimize the effect of the interest rates on sales. The adjustment is to remove the net effect of interest income and interest expense from the sales number. So in essence, the sales number is reduced by whatever the difference is between interest coming in and interest going out. Next.
5 minutes, Roger, 5 minutes.
All right. Axos history. Let's see, what do we have here? Only the last 5 years. I've only shown the last 5 years of earnings and sales, because this is the way I look at companies when I do an analysis. I only look at the last 5 years. Better Investing recommends you have 5 years worth of data, and to keep everything on an even plane, I say I'm only going to look at 5 years. These look nice. They're up and to the right. And so they look very well. They've had one bad year there for prices, if you'll see, that was 2020. It's probably called pandemic, but that's the only hiccup in there. Next. Forecasting the future sales and earnings. I look at the last 5 years, and their growth rate for the last 5 years has been 15.1% for sales and 18.7% for earnings. So I chose to use a kind of a little conservative at 15% for both. Next. Looking at the management of section 2, pre-tax profit, return on equity, and return on average assets are all up. The debt to capital is down, which is what we would like to see, that debt is down. But the other ones are where we'd like them as well. Next. In the high and low PE section for picking out how we're going to calculate highs and lows future prices, I have a technique that I use for doing this. I go in and eliminate the two highest ones, and then I look at the other three and I eliminate the one, well, I save the two that are closest together. So in essence, I'm either eliminating the highest three or the highest two and the lowest one. In both of these cases here, it's the highest three. With these removed, the average 5-year PE ratio is 7.6, and the current one for the company is slightly below at 7.3. Next.
2 minutes, Roger. 2 minutes.
All right. Going through the analysis, picked out a high price of 110.8, and looking at low price, I looked at the different categories there. And with low price, I look at A and C and 80% of the current price, which was $30.60 when I did this. Of those, the average low price, I'm sorry, 80% was $31.97. The lowest of those was A, the $30.60, and I took that and just rounded it to the nearest number and used 31 for a selected low price. In doing this, the current price, which was last Thursday's of $39.96, fell into the buy category, and it with an upside downside ratio of 7.9 to 1. And a potential price appreciation of 177%, which I think we'll see on the next slide as well. So next. And there we have it. There's a 7.9 for upside downside and 177.3 for price appreciation. Next. Section 5 is where we're going to take a look and see how things go. It didn't have, they don't pay a dividend, so we don't have to deal with that here. It's just basically the value that could be added to the price of the stock. The projected return using the forecast average PE is 7.3. The price to satisfy the upside downside of 3 to 1 and 15% is $51. And the closing price on Thursday was $39.96. I have the closing price from today, which is $39.49. So it went down a little bit. Next. And in conclusion, Axos is a small size, fast growing company. It's a well-managed company. It's fairly priced, trading near its 5-year average PE, and it's a buy up to $51. And it's a worthy candidate to purchase. And my parting words are, don't take my word for it, do your own analysis and research.
Thank you very
That's my last slide.
Thank you very much. Well, we went through those fairly quickly, but so we're going to do a little recap here. We're going to go back over Edward Lifesciences, the 3M company, Axios, and Palo Alto Network. So let's go to the next slide. And what we want to do is ask everyone sort of where they think it's on this continuum, which is something that shows up a lot in the handbook and the like. And let's start with you, Ken. Why did you pick that location for Edward's EW, Edward Lifesciences?
Of course, Edwards is a well-established company. It's been around since the late 50s. But again, keeping in mind that they do have a growth goal to be at 10 billion in sales in 2028, which would kind of make them a large company. They're not quite there yet, so I don't think they're mature growth. So I put them toward the end of explosive growth.
Okay. And Ed, tell us why you picked that location for Palo Alto Networks.
So first of all, it's only now kind of becoming profitable, so that kind of kept it down towards the bottom. I also think that with the cyber market exploding over the next decade or so, that it is in a great position for some substantial growth of their products and subsequent explosive growth of sales to new customers. Thanks.
Okay. And Bhaskar, tell us why you picked that location for 3M.
Yeah, it is a very large company and very old company for many years. Their growth is like slowing down, or it has almost like stabilized. It has to be in that place.
Okay. And Roger, tell us why you picked that location for Axos.
Well, originally I picked one that was lower in the green circle there, but I realized they've been around for 23 years, and so I figure they're probably a little bit higher up on the chart there for their growth. So that's why I picked it up there by the G.
Okay. Thank you very much. All right, let's go to our next slide. And I think at this point, we've been doing talking for a long, long time. And now it's time for you as the audience to go ahead and vote on which one you like. So Cheryl, go ahead and release the poll. So it doesn't cost anything to participate. We won't know who you voted for, but let's take a look. We got about 50% of you voting already. Getting up over 70%. No, that's good. See if we can push it up towards 80%. We get any more voting? Sort of holding there. One more. Let's see if we can get one more vote. Can we get one more vote? Yeah, there we are. We're over 80. Any higher? Go ahead, close it out, Cheryl. That's good. And there we have it. That was pretty close. No one liked 3M. But you look at that, a dead heat between Axios and Edward Lifesciences. So we'll mark that in our book there and go forward. We can keep this up. Jonathan, are there any questions from the audience? It looks like it's been a pretty quiet night. Has it been?
Yes, it has been. There's no questions at this point.
Well, if anyone does have questions, I know we have some people, we have 4 or 5 of you that took the class that the DC chapter put on. If you have any questions, go ahead and raise your hand. We can unmute you and you can be able to tell us what you got. Anything? Bueller, anything? This is a quiet night, quiet crowd. We may have to make a requirement that people have to ask questions when they come on here. All right. At the moment, let's just go to our next slide and we'll see if there are any, we'll keep an eye on that. So if you do have any other follow-up questions, here's a way that you can be able to reach us both at the Maryland chapter and at the DC chapter. Here at Digging Into the BI, we have a Gmail account for that. And there's a picture of us from both the Maryland and DC chapter when we got together at the last in-person BINC, Better Investing National Convention. That was in Dallas of last year. And heck, I think just about everyone in that picture is here in the audience tonight or in the back room with us. So nice shot for all of us. Next slide, please. If you want to be able to be informed of this, make sure to sign up at the DC Regional Chapter. Carol sends out a really nice notice. We don't inundate you with a lot of stuff other than the book club, maybe some special events, and the SSG class that we just finished teaching. Next slide. Jonathan, you want to tell us, or no, I give this usually to Kent. Kent, you get this. I'm sorry.
All righty. Well, as Kevin mentioned at the very beginning of this particular webinar, everyone who works with the Maryland and DC chapters are volunteering their time and their energy to make this webinar happen. So digging in the BI happens because of our volunteers, as well as the chapters, the work that the chapters do with the SSG classes. You heard about 2 of them this evening, as well as book study group, which we heard about this evening, and the interactions that folks have with various model groups. So all of that happens with volunteers. And the whole idea with volunteering is that you can learn new skills, you can help plan local events and classes, and as a result, you end up getting a lot of good investment knowledge, and you get some discounted rates to training programs, events like the Better Investing National Conference, which is coming up in Chicago in a few months, and you also get good complimentary subscriptions to the Better Investing website tools. So thanks.
Thank you. All right, let's go to our next slide. Here's what's coming up next month. We have 5 below Estee Lauder paychecks and one to be determined. And if you want to be the person who makes that presentation, please raise your hand, please put it in the chat, or please reach us at digging.into.bi@gmail, and we will work with you on that. Jonathan, any more questions, or are we pretty much, we got a bunch of church mice tonight?
Yeah, there are no questions. It's quiet as kept, I guess.
Kevin, I think you're muted.
I
think
am.
so too.
Yeah, I am. Yeah, so I was talking away to an empty microphone. Anyway, so here's what we got coming on up in December. We have 5 below Estee Lauder paychecks and one to be determined. So if you want to be the person to do that stock presentation, please reach out at digging.into.bi@gmail, and we'll definitely work with you to be able to get that presentation going. Other than that, let's go to our next slide and see what we have. So we're also up on Manifest. Again, you don't have to, this is a separate subscription. If you're not a member of that, you'll be able to see these public dashboards and you can be able to take a look at them. And here they are. Let's go to the next slide and we'll show you all of them. And again, if you downloaded these handouts, those hyperlinks will take you directly to those locations to see where they are. So anyway, take a look at them. You can see how we've performed. They basically put in a fake, I think it's $100 when the stock was selected, and we can just sort of track it to see if it's doing well. Next slide. And finally, we will have this up on YouTube, hopefully a lot quicker than we did the October one. But that's really it. One last look. Any questions, any hands up? Anyone out there?
I just want to state that please download the handouts because you cannot download them in YouTube. So please take a moment right now and download those 5 handouts for yourself.
Well, I want to be able to thank all of our presenters for helping us out. And thanks to all of you that have been here regularly. I see several regular folks there. And I noticed we had several of our people from our SSG class. And whether you do the in-person one that the Maryland chapter had a couple weeks ago, or you do the one that we did that was online, glad to have you. We're here to help. And we will see you next month when we will dig into the BI for December. Thank you all for being here. Have a good night.